Hey yo, what's up everybody? Good day to you all, ladies and gents. Welcome back to Matrix Investing, the #1 YouTube channel that is dedicated towards giving you education based on investing in capital markets. Now in this video, we're going to look at the price to book ratio, its uses to investors, the challenges they have using it, as well as how it can be used on an actual company. Now if this is the first time you're watching our videos, we highly advise you to check out our previous videos so that you can have a better understanding of what exactly we're teaching. If you also find this video useful, we advise you to like this video, subscribe to our channel, and hit that notification bell so that YouTube gets to notify you each time we get to upload videos into their platform. Now with that said, ladies and gents, let's get down to business. So starting off by defining what the P/B ratio is. Now this is a ratio that is used to compare the share prices and the book value per share by looking at how large the market price of a company is in comparison to its book value per share. It is found by taking the share price of a company and dividing it by the book value per share. So this metric simply tries to compare how large the market price is in comparison to the book value per share, of which we learned in the previous video. So then the larger the ratio shows that the company's shares are sold at a more expensive price, while the smaller the ratio shows that the company is sold at a more cheaper price. So this ratio is used to compare companies that are in the same economic sector by taking the average ratio and comparing it to individual companies that are in the same sector. So as far as economic sectors are concerned, the price to book value ratio can be useful in the case where one finds the price to book value ratio of all individual companies in a specific sector, finds the average price to book value ratio, and the average ratio will be used as a benchmark for companies that are in that particular sector, meaning that companies with a higher ratio than the average are overpriced, while companies with a lower ratio than the average are underpriced. The use of such tactics have come as a solution to majority companies of which its share prices are usually larger than the book value per share, although they might still be well-performing companies. So then even though the share prices are larger than the book value per share, so this has come as a way, as an advancement on how to use the book value per share as to figure out which one is overpriced and which one is underpriced. So this ratio is used by investors in finding companies that have high growth in profits, shareholders' equity, while still having shares sold at a very low price. So as for this case, let's not forget that investors aren't just looking at underpriced companies, but underpriced companies with great potential. So therefore, looking at factors such as consistently growing profits and capital with a low price to book value ratio are more likely to be prioritized and get heavily invested upon by investors. So if the result of this ratio is less than 1, then that means that the company is underpriced. But if the result of this ratio is greater than 1, then that means that the company is overpriced. So mathematically, anything greater than 1 is overpriced. Anything equaling or approximately equal to 1 is a fair price, and anything that's less than 1 is underpriced. But, however, since we are aware that most companies have a higher market price than the book value per share, which means that the ratio is obviously going to be greater than 1. Most investors have considered 3 as their general benchmark. So basically, since mathematically we know that anything greater than 1 is overpriced and anything less than that is underpriced, and we all know that most companies are probably overpriced if we use that metric, so then most investors decided to stick with a general rule of 3. So the P/B ratio should be somewhat around 3. So anything greater than 3 is overpriced, and anything less than 3 is underpriced, anything equaling or approximating to 3 being the fair price. So, challenges behind using the P/B ratio. Challenge number 1, this ratio is invalid for companies with a negative book value per share. So this ratio works for book value per share with positive value. However, this really isn't a problem to us, as we all know that good investments do not possess a negative book value, meaning that its liabilities are greater than assets. So in the case that we do find a company with a negative book value or negative equity, we just ignore that company because we know it's a bad one from the start. Challenge number 2, it's not suitable for comparing companies in different countries. Now this is due to the difference in accounting standards and policies in how to represent capital, which is the book value. So then this renders the book value unworthy for comparison. So here we are, ladies and gents. This is the formula. We simply just take the share price and divide that by the book value per share. So with that seen there, let's get on to see how this can be applied on an actual company. So here we all are, ladies and gents. We have opened the TCCIA Investment PLC annual report as of the year 2019. And the main objective as to why we've opened this annual report is so that we can get to find the book value per share. So for us to do that, our first step will be to go to the statement of financial position. And from there, we're going to go to the total equity section, of which as of 2019, the total equity was worth 27,096,381,000. So then we're just going to pull that out right there, and we're going to take 27,096,381,000. And then we're going to have to divide that by the total number of shares that are available in the business. But hold up, before we do that, we need to check if there's any sort of preference shareholder equity, of which I do not see any on the equity section. So then that means that this company is preference shareholding free. So then there's no need to deduct anything from the book value per share. And our next step will be to go to the part where we're told of how many shares are available for common shareholders, of which you can get that information in the earnings per share. So then here it is, weighted average shares in issue. That's 72,957,660. So then that's the total number of shares that are available in a company. In this company, so we're going to take 72,957,660. And from there, we should be able to get 371.3987, all that stuff. And this is the book value per share. So then to complete the equation, the P to B ratio, we are going to have to go to the market report from ESE, and TCCIA is represented as TICL, which is right over here, and the share price is 350. So we're going to take this 350 and we're going to divide it by the book value we just got there, which is 371. So then we'll have to take 350 and we're going to divide that by 371, and the answer we're going to get is 0.9439, all that stuff. So then mathematically this is less than 1, which makes it plain as obvious that this is undervalued, that this company is undervalued. Its book value is higher than the market price. We could even see it just by comparing. So then the next step as an investor would be to look at all the other financial metrics, to look at how the company is performing, and to perform much further analysis that could make you derive to a conclusion as to whether this company is well off in other sides. I mean, if the company is underpriced, we need to find the reasons why it's underpriced. Maybe it's underpriced because it's bad, but then maybe it's underpriced because no one has seen the potential in it yet. So then you need to perform further analysis and figure out as to whether this company is good enough or not. With that said, ladies and gents, thank you so much for watching this video to the very end. If this video has been useful to you, we then ask that you help us by hitting the thumbs up button, subscribing to our channel, and hitting that notification bell so that YouTube gets to notify you each time we get to upload more videos like these into their platform. So then share this video to your buddies. Sharing is caring and knowledge is power, so that they can also benefit from this video just like you. If you're also on social media platforms, Instagram, Facebook, and Twitter, don't forget to check us out there. Our account name is Matrix Investing. The links to our social media accounts are in the description below. We provide content related to investing in the Tanzanian capital market on a daily basis, so don't forget to follow, like, share, and comment. If you also have questions or opinions to contribute, you can do so on the comment section or DM us on our social media accounts. So anyways, thank you all so much and have a great day.